So this week we are continuing our discussion of investments. And again, this is when companies purchase investments and hold investments. And again, as we discussed in the lecture, corporations and companies, they will choose to do this for a variety of different reasons. And so we'll go over some examples that should be at least somewhat similar to what the homework is. Accounting for debt investments that are classified as trading. Brooks Company purchases debt investments as trading securities at a cost of $66,000 on December the 27th. And this is the first and only purchase of such securities. On December the 31st, these securities had a value of $72,000. And so we're going, first of all, to prepare the December 27th entry for the purchase of the debt instruments. And so you'll have the date again, which is be December the 27th. So you have debt investments trading in the amount of $66,000 debit, and then a credit to cash in the amount of $66,000. And the reason for this is because we need to record an increase in our assets in terms of the debt instruments trading, and then we need to record the associated decrease in cash because we're paying cash out to purchase these securities. So we see then that we should have a debit balance in the debt investments trading in the amount of $66,000. So they purchased this within a year. Now December 31st rolls around and we have to do all of our closing entries and all of that in order to get ready for the start our books in January 1. So we're going to prepare the December 31st end of year fair value adjusting entry for the trading securities portfolio. So in order to do that, then to start out with fair value adjustments trading, to start out with has a $0 balance, debit balance, because this is the first time that we've purchased any securities. So we start off with zero, and then we're going to have to make an adjustment because these have an unrealized increase in value. So we're going to figure this out, that we had a fair value adjustment trading debit in the amount of $6,000. And the reason for that is that these securities, these debt securities, are currently valued at $72,000. We paid $66,000 for them. And so we would subtract the two of those, and then we didn't have any balance yet in the fair value adjustment trading account. So we wouldn't have to deal with that. So $6,000, and then we have a credit for unrealized gain income of $6,000. And then that will go on to the become part of the income statement. Now, let's say then that on January the 3rd, Brooks sells a portion of the trading securities that cost $3,000, $4,000 in cash. So the securities originally cost $3,000. Brooks is going to receive $4,000. So you would record a debit in the amount of $4,000 for cash because Brooks is receiving $4,000 in cash. And then you would record a credit for debt investments trading for $3,000 because the securities originally cost us $3,000. And then we're going to record a credit in the amount of $1,000 for the gain on sale of debt investments, because we have to record that. And again, that would go onto the income statement later. Accounting for held to maturity debt instruments. We will prepare Natura Company's journal entries to record the following transactions involving its short-term investments in held to maturity debt securities, all of which occurred during the current year. So the first is on June the 15th, we paid $1,000 cash to purchase Remed's 90-day short-term debt securities, which is $1,000 in principal, dated June the 15th, and that pays 10% interest, and these are categorized as a held to maturity security. So rather than what we did before, where we could decide that we want to sell them, anytime. These, we're going to hold them until maturity. So in this case, we're going to hold them until we get back our original principal, and then we're going to get our interest. So the first thing is we're going to record the purchase. So we have debt investments. This time it would be debt investments -HTM, because we're holding these till maturity. A debit in the amount of $1,000. Then we'll have a credit to cash in the amount of $1,000. And this records the increase in long-term asset for non-current asset for the investment, and also then records the decrease in asset for cash. So then on September the 16th, we received a check from Remid in payment of principal and the 90 days of interest on the security. And again, remember that we use 360 days in a year to figure out how much interest that was. Again, to record this payment that we received from Remid, we would have to credit cash for the total amount of cash that we received, which is for $1,025. We have to record a credit to interest revenue of $25, and we figure that out by taking $1,000, which is the principal, multiplied by the annual interest rate, which is 10%, multiplied by the percentage of that for the year. So it'd be 90 out of 360 days. So we'd figure all that out, comes out to 25. So we earn $25 of interest. We also credit the debt investments HTM for $1,000, because now these securities have matured, and so we no longer own them, because the Natura company no longer has any obligation to us at this point, because they've paid us back the principal, and then they paid us the interest for that 90-day period. Now we'll record the accounting for available for sale debt securities. Prepare Crumbs Company's journal entries to record the following transactions involving its short-term investments in available for sale debt securities, all of which occurred during the current year. And so the first one is that on October the 1st, we paid $50,000 cash to purchase HOTI's 9% 6-month debt securities, which is a $50,000 principal dated on August the 1st. And so August the 1st, this time we have debt investments AFS, debit for $50,000, and then cash for $50,000. Same thing as we've been doing. We have to increase debit for the asset, which is the debt investments that we're investing in, and then we have to credit cash, because we're decreasing cash, because we're paying that out to receive the investment. Now, on October the 30th, we received a check from HOTI for 90 days interest on the debt security purchased in that. Again, use 360 for a year. So we figure out the interest, and that would be $150,000 multiplied by the interest rate, which is 9%, multiplied by the amount of time that has passed. In this case, it's 90 days. So 90 divided by 360, and you come out with that you are receiving $1,125. That would be a credit. Then you would debit cash, the amount of $1,125, because you're receiving cash. And you have to, as I say, you credit the interest revenue, because that would go on the income statement as part of your revenue that you're receiving. We'll do a fair value adjustment for available for sale debt securities. On December 31st, Lujack Company held the following short-term available for sale securities. Lujack had no short-term investments prior to the current period. So we'll prepare the December 31st year-end adjusting entry to record the fair value market adjustment of the securities. So we see here listed out the cost and then the fair market value. So we see that Nintendo Company notes, that increased in value. Atlantic bonds, we see decreased in value. Kellogg Company notes decreased in value, and McDonald's Corp bonds decreased in value. So we see that actually we had a loss, unrealized loss. It's not realized because we haven't sold these notes and bonds yet, so it still would be considered an unrealized loss. Once we sold them, then we would realize the loss. So then we see here the total amount, which is $850 loss. And then they had an unadjusted balance in the fair value adjustment account. They didn't have any previous to this. And so the adjustment we have to make is $850. They just see here the T accounts to show that. So we have a $164,750 debit in the debt investments AFS account. But we have to go ahead and make an adjusting entry over here in our fair value adjustment AFS account for $850, and that is for the loss. There wasn't anything in there before. If there had been, then you would have to take that into consideration, the previous balance that was there. So we have an unrealized loss on equity, the amount of $850 debit, credit to the fair value adjustment AFS for $850. A multi-year fair value adjustments for available for sale debt securities. And again, so this happened just once. So this would be figuring it out if it happened over multiple years. So Ticker Services began operation in year 1 and held long-term investments in available for sale debt securities. The year-end cost and fair values of its portfolio for these investments follow. Prepare journal entries to record each year-end fair market value adjustment. We see here then for year 1 that they had a gain of $2,000. You will have a debit to fair value adjustments AFS for $2,000, a credit to the unrealized gain equity for $2,000. Now in year 2, we see that the cost of them was $20,000. They had a fair value of $25,000, so we had a $5,000 gain. So we see that here. So the amount of adjustment that we need to make, there was already a $2,000 in there. Now we want it to be $5,000, so we need to add $3,000 to it. So the adjustment that we're going to make is for $3,000. And so we have a fair value adjustment AFS debit for $3,000, credit to unrealized gain equity for $3,000. Now for year 3, we see that they had a $6,000. And so we see then that we need to, it already had 5, we want it to be 6, so we need to add 1,000 to it for the gain. And so we have a debit to fair value adjustment AFS for 1,000, credit to unrealized gain equity for 1,000. And then for year 4, we see that they had an increase of 2,500. And so this time we had 6,000 there. We need to make it the balance to be a debit balance of 250. So then we need to credit 3,500 then in order to make that right. So this time we're going to have a debit to the unrealized gain equity this time of 3,500, and then we're going to have a credit to fair value adjustment AFS for 3,500. Look at accounting for stock investments with an insignificant influence. Prepare the journal entries to record the following transactions involving the short-term stock investments of Duke Company, all of which occurred during the current year. And so the first entry we'll look at is on March the 22nd, we purchased 1,000 shares of RPI company stock for $10 per share. Duke's stock investment rules results in it having an insignificant influence over RPI. So we have stock investments in the amount of $1,000 debit, then we'd have a credit to cash in the amount of $10,000. Now, on July the 1st, we received a $1 per share cash dividend on the RPI stock purchased in Part A. And so in this case, we know then that it's $1,000 because we had 1,000 shares, we're receiving $1 a share. So we would debit cash in the amount of 1,000 in order to increase cash. Then we would credit the dividend revenue for 1,000. Again, dividend revenue, that's going to go on to as part of your income statement. Now on October the 8th, we sold 50 shares of RPI stock for $15 a share. So we have cash, the amount of $750. We figure that out by taking the number of shares that we sold, multiplying by the amount that we sold them for. So in this case, 50 shares multiplied by $15 a share comes out to $750. Then we would credit the stock investments. And again, this would be for the cost. So 50 shares at $10 a share cost is $500. So credit. Then we would credit the gain on sale of stock investments for $250, because that's how much the difference between $10 a share and then the $15 a share that we actually sold them for. Fair value adjustment to stock investments with an insignificant influence. So on December 31st, Mars Company had the following portfolio of stock investments with insignificant influence. Mars had no stock investments in prior years. So we'll prepare the December 31st adjusting entry to record these investments at fair value. And so we see that overall that we had a $1,500 gain, because we see that Apple stock went up, the Chipotle stock went down, and then the Under Armour stock went up. But overall, we had a $1,500 gain. We look at the totals for those. We see here that the total cost of the stocks was $22,000 debit to the stock investments. And then we have the fair value adjustment for stock account. We see that unadjusted, since this is the first year that Mars owns stock, we have a zero balance there. The amount of gain was $1,500. And so in order to show that, we will debit the fair value adjustment stock by $1,500. So then we have fair value adjustment for stock in the amount of $1,500. Then we have an unrealized gain on income for $1,500. The accounting for equity method investments. Listed below are a few transactions for Kodak's company. So we'll prepare the journal entries to record the transactions for the Kodak's company. So the first one would be under year one, would be January the 2nd, year one, as we purchased 30,000 shares of Greco company common stock for $411,000 cash. Greco has 90,000 shares of common stock outstanding, and its policies will be significantly influenced by Kodak's. So we would have a equity method investment for the amount of $411,000, credit to cash the amount of $411,000. Okay, very similar to what we've been discussing before when we purchase a security. Now, on September the 1st, Greco declared and paid a cash dividend of $1.50 per share. So we have cash, the amount of $45,000, because we own Kodak's owns 30,000 shares, and they're receiving $1.50 per share. So they receive cash, the amount of $45,000, and then equity method investments we would credit for $45,000. Again, the accounting here is a little bit different, because since this is the equity method investment, it's because they actually own a major part in the company. And so they actually have a lot of influence over the Greco company. And so because of that, what happens at Greco, it does affect Kodak's, because we see here that Kodak's owns 33.33% of Greco. So in December 31st, Greco announced that they had a net income for the year of $486,900. So we would have a debit to the amount for equity method investments for $162,300. And that would be their portion, 33 1/3 of the net income that Greco had. So they would record a debit for that, and then a credit for the earnings from equity method investments for $162,300. And then in year two, in June, Greco declared and paid a cash dividend of $210 a share. So again, we have a debit to cash in the amount of $63,000. Again, 30,000 shares multiplied by the amount per share of dividend, which is $2.10. And then we would credit that to the equity method investments of $63,000. Now on December 31st, Greco announced a net income for the year of $702,750. And so again, you want to figure out their portion of it, which is a 33 1/3. So it would be equity method investments, again, 702,750 of net income multiplied by the percent of ownership that Kodak's has in Greco, then is going to be a debit for the amount of 234,250, credit the earnings for equity method investments for 234,250. And then Kodak sold 3,000 shares of Greco for $71,000 in cash. So we would have a debit to cash, the amount of $71,000, because Kodak is receiving $71,000 in cash. Then we would have a credit to the equity method investments in the amount of $69,955. And again, the reason for that is you have $699,550 multiplied by 3,000 of the 30,000 shares. And so that would be what would then currently be in their account for that, for the amount for what would actually be in the equity value investments. And in that, and then the gain on the sale, they sold them for 71. So the gain on the sale then is 1,045. We will classify investments and securities, and we will record the fair values. All right, so investment regarding CarPerks company's individual investments in securities during its current year, along with the December 31st fair values follows. Then we'll prepare a journal entry dated December 31st to record the fair value adjustment of the long-term investments in available for sale debt securities. CarPerks has no long-term investments prior to this year. So we break everything down and we look at the different bonds that they have. So the first one is the Brava company bonds. That's a long-term debt investment that's held to maturity, because it says here investment in Brava company bonds. Anyway, and they intend to hold the bonds until they mature in 5 years. And in Bay Ridge common stock is that they have investment in Bay Ridge common stock, and then CarPerks owns 32% of Bay Ridge's voting stock and has significant influence over Bay Ridge. So those are long-term, those are equity securities. Then they have an investment in DERFA bonds. This investment is not readily marketable and is not classified as held to maturity or trading. So it's a long-term, it's a debt investment, but it would be an available for sale. And then Newton common stock. And again, we add that because those are available for sale securities. And so we can figure out that, that the DUFA common stock cost $165,500 and that the current fair value of it was $178,000. Now they have investment in Newton notes. Newton notes are not readily marketable and are not classified as held to maturity or trading. And so again, that is a long-term for Newton common stock. It's long-term. It's a debt investments available for sale. Cost us $90,300. Current value is $88,625. And then they have an investment in Farmers common stock. This stock is marketable. CarPerks intends to sell it within a year. This stock investment results in CarPerks having an significant influence over farmers. And so because they're going to sell it within a year, it is a short-term investment and it is stock investments less than 20% of the company. And so the total cost for the available for sale long-term investments is $255,800. Total fair value of those is $266,625. So we have an unrealized gain in the amount of $10,825. And so we would record this with a debit to the fair value adjustment AFS for $10,825 and a credit to the unrealized gain equity in the amount of $10,825. $825. We'll prepare a statement of comprehensive income. So we're going to use the following information from Prescript Company to prepare a calendar year-end statement of comprehensive income. So you have total comprehensive income of $9,400, net income of $10,000, change in value of available for sale securities of $2,000, which is a loss, other comprehensive income, which is $600, which is a loss, and a change in foreign currency translation of $1,400. And so for Prescript Company, the statement of comprehensive income for the year end of December 31st, you have net income of $10,000. We have change in value of available for sale securities of $2,000, which is a loss. Change in foreign currency translation of $1,400, which is a gain. Other comprehensive income, we have results then that it's a $600 loss. And again, we see that because we take the 10,000 minus the 1,400 is 600. And so we have total comprehensive income then of $9,400.